After 15 years of helping small businesses deal with SARS, I can tell you this. Most tax problems are not caused by one big mistake. They're caused by small decisions repeated every month. Quick transparency note before we continue. I am Sia's digital twin, created to explain tax and business topics in a simple way. The real Sia wrote the technical direction for this video, while he is busy helping clients in the practice. Sia is a registered accountant, and over the past 15 years, he has helped more than 2,000 small businesses save on tax, stay compliant, clean up SARS issues, and avoid unnecessary penalties. So in this video, I want to give you the tax advice every business owner should know before SARS starts asking questions. Advice number 1, separate your business money from your personal life. The company bank account is not your personal wallet. The moment you start paying school fees, groceries, bond payments, holidays, and random personal expenses from the company account, your records become messy. And here is the dangerous part. At year end, those payments still need a tax treatment. Were they salary, dividends, reimbursements, loan account movements, drawings, or personal expenses paid by the business? The cleaner your records are, the easier it becomes to claim real business expenses and defend them if SARS asks questions. Advice number 2, claim real business expenses, but keep evidence. Many businesses overpay tax because valid expenses are missing from the accounting records. Accounting fees, software, business phone costs, internet, staff training, marketing, business travel, bank charges, insurance, and professional subscriptions can all matter if they are genuinely business related. But do not confuse tax planning with inventing expenses. A deduction must be linked to the business, properly recorded, and supported by invoices, slips, or proper documents. If the expense is real, but the evidence is missing, SARS may still challenge it. That is the frustrating part. You may have spent the money, but if you cannot prove it, the tax benefit can disappear. Advice number 3, understand salary versus dividends before taking money out. This is where many company owners get confused. Salary can reduce company profit, but it can also create payroll obligations like PAYE, UIF, and possibly SDL. Dividends, on the other hand, are usually paid from after-tax company profits. They are not a normal business expense, and dividends tax is generally withheld at 20% for individuals, unless a specific exemption or reduced rate applies. So which one is better? That depends on your profit, cash flow, personal tax position, compliance status, and whether the company has retained earnings. The mistake is taking money first and only deciding later what it was. Before we go further, if your business has messy owner withdrawals, unclear loan accounts, or you are not sure whether salary or dividends make sense, schedule a free SARS risk check with us. The link is in the description. We can help you look at your actual numbers before the problem becomes expensive. Advice number 4, check whether you qualify as a small business corporation. This is one of the areas where a qualifying business can save real tax. Small business corporations may qualify for reduced corporate tax rates and accelerated write-offs on certain assets. But not every small company automatically qualifies. SARS looks at things like turnover, shareholding, investment income, personal service rules, and other requirements. So do not assume you qualify just because your business is small. But also do not ignore it if you might qualify, because missing SBC treatment can cost money. Advice number 5, plan VAT and PAYE before they become debts. VAT collected from customers is not really your money. After allowable input VAT is considered, the balance belongs to SARS. PAYE deducted from employees is also not working capital. This is where businesses get trapped. The money comes into the bank account, cash flow feels better, and the owner uses it to pay rent, suppliers, or personal expenses. Then the VAT or PAYE deadline arrives, and suddenly SARS is the creditor. At that point, the issue is no longer just tax. It becomes a cash flow problem, a compliance problem, and sometimes a tax clearance problem. Advice number 6, use provisional tax as a planning tool, not a surprise bill. Provisional tax is not there to irritate you. It should force the business to estimate profit during the year. The problem is that many owners guess. They do not prepare management accounts before provisional tax dates. They do not know whether the business is profitable. So they either underpay and face penalties, or they get shocked at year end when the final tax bill arrives. Good provisional tax planning starts with current records. If your bookkeeping is 3 or 6 months behind, your tax estimate is not planning, it is gambling. Advice number 7, do not wait for SARS to tell you something is wrong. By the time SARS sends a notice, the issue has often been building for months. Every month, review VAT, PAYE, income tax, your SARS statement of account, tax compliance status, and outstanding returns. This does not have to be complicated, but it must be consistent. Let me give you a simple example. A business earns 200,000 Rand per month and spends 120,000 Rand on operating costs. On paper, it looks healthy. But the owner takes random personal payments of 35,000 Rand per month, forgets some supplier invoices, keeps weak records, and treats VAT money as available cash. After a few months, the business may not know its true profit. It may have missed valid deductions. It may have VAT pressure building quietly, and the owner withdrawals may need to be cleaned up properly. Now compare that with the better version. The business sets aside VAT and PAYE money, records all invoices, pays the owner a planned amount, and reviews profit every month. The tax saving is not only from clever deductions, it comes from clean classification, proper evidence, and avoiding penalties. So here is the big lesson. Good tax planning is not about tricks. It is about clean records, clear decisions, proper documents, and acting before SARS forces the conversation. If you are not sure whether your business is clean from a SARS point of view, book a free SARS risk check with us. The link is in the description. We will help you see what is outstanding before SARS forces the issue, so you can fix problems while you still have options.